Alrighty, everyone. Thank you so much for joining on with us today. We are very pleased to have everyone here. Additionally, we do always like to bring on great guests. Today we have Heather Dreves from Central Lending. We're going to be talking about investing into debt instruments for commercial investors. With regard to how that works with doing it through funds and directly, and a whole bunch of other very interesting and compelling information. So please, thank you very much for joining. If you do have any questions, make sure that you do type those into the chat box. I will moderate those and ask those to our guest presenter today. So again, if you do have any questions, just make sure you are typing those into the chat. My name is Alex Perny. I've been with Advanta IRA since 2012. If you have any questions specific to IRA investing in this context, always feel free to reach out to me directly. My number is listed up on the screen, and if you are just listening in, it is 727-754-9954. A quick disclaimer before we get started: Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. A little bit about Advanta IRA. We have over 20 years of industry experience, specifically only doing alternative assets through IRAs. So if you're interested in investing into some type of private equity, real estate directly, and precious metals, anything else under the sun that's not a traded stock, bond, or mutual fund, we can help you out with that directly. We have over $2.8 billion of assets under administration that we have through our clients, and that is representative of almost 10,000 individual account holders, a number that we're very proud of. We've been doing this for quite a while, and we're very happy for the success and the amount of help that we've been able to provide our clients as well. Additionally, any cash that you deposit with us is not losing any specific protections. If you are going to be investing outside of a brokerage, we do carry FDIC insurance on all deposits up to applicable limits. And lastly, all accounts that are open with Advanta have a personal dedicated account manager. So you have personal on-demand personal and on-demand assistance for anything that you need with regard to your IRA. So you don't have to pay for any type of upgraded service. Any account that is held with us has dedicated direct account management to help you make the investments in a timely and efficient manner. With that said, I'm going to turn it over to Heather for the remainder of the presentation. Heather, I want to thank you very much for taking the time out of your day to be with us and to present to our audience on this very interesting topic. And with that said, I'll turn it over to you, Heather.
All right, well, we'll get started here. I've got a lot to cover. Thanks again to Alex and Advanta for inviting me and having me be part of the webinar. I've been in the industry a very long time, over 20 years now, and one of my favorite type of client to work with is people that are utilizing their self-directed custodial accounts. I have those types of accounts myself, and my husband and I understand how powerful those are. Alex came to me and wanted me to talk and educate a little bit about what it really means to invest in a fund versus a direct deal. I get a lot of clients that call me up, and sometimes they will come to me with an opinion of how they want to deploy their capital, and upon talking with them further and really digging into what they're trying to accomplish and the kind of dollars that they're trying to invest, sometimes the realization is that really wasn't what they needed to be investing in the first place. And so I think it's important to really just kind of understand the differences, the pros and cons to both. They're both great investment vehicles to deploy capital in, but there are definitely some things you need to understand about them. And so I'm going to dive into that, today, from a high level, and, I can always help people and talk more about it offline, but I do want to encourage you folks that are attending the webinar, please, I want it to be interactive. Alex is going to man the chat box. And so, as we see these comments or questions come in as we're going along the presentation, I don't want to have you guys just sit here and listen to me talk for an hour. But I want this to be interactive, and, I'll do my best to address those things as they come up. So questions, comments, concerns that you guys might have about this, please put them through on the chat, and we'll do our best to address those as we go along. So we're going to get started here. Again, my name's Heather. I am with Central Lending. All right, just a quick disclaimer, to keep my legal at bay. This post and the information contained herein is for informational purposes only. Under no circumstances does any of this information posted represent a recommendation or solicitation to buy or sell of securities or interest or in any way constitute investment advice. Central Florida Income makes no representations as to the accuracy, completeness, suitability, or validity of the information contained herein. The ideas and strategies should never be used without first assessing your own personal and financial situation or without consulting a financial professional. Basically, I'm not a financial advisor. I'm not giving you financial advice. I'm just educating you on the differences between these two different types of investments. So we will not bore all of you to death. All right. Oops. Let me go back one. Sorry. Okay. So real estate funds versus direct deals and notes. And I know that both of these topics are really popular with people with self-directed IRAs, and I definitely think there is a lot of opportunity to create wealth through your self-directed accounts, tax deferred or even tax-free if you're using Roth IRAs, but I think it's important to understand the differences. And so we're going to talk about that today. They both have their benefits, but there's also things that you should also take into consideration when looking at these two different types of investments. So let's first talk a little bit about funds, because they have become very popular even just over the last 5 years. When I got into this industry, really the only way to deploy or invest your dollars in these types of assets was to buy a direct deal. And I think that with funds coming into this industry and making them available to a lot of investors, and quite honestly, back in the day, they were only available to accredited investors. And I know of funds right now that actually will allow for unaccredited investors to invest in them. But essentially, when you're investing in a fund, you're basically investing in a common pool with a bunch of other investors. So you have a fund manager. Central Lending is a fund manager. We manage 2 funds, and you basically are pooling your money in an entity, and the fund manager is the management team that is responsible for making the investment decisions on behalf of the fund. Now, there's a lot of reporting that goes on to this, or into this to you as an investor, and it's important when you are doing your due diligence on fund managers that you're asking them those types of things. How often do you report? How often do I get paid my earnings? Are you an audited fund? And that's whole nother presentation on how to do due diligence on an operator, and I'm happy to give you guys that information. I'm not going to get too deep into that. But essentially, again, you're investing in a pool with other investors. The fund manager and the management team is responsible for making the investment decisions on behalf of the fund. The fund manager should be expected to conduct their research, analyze the markets that they're investing in, and strategically buy and sell assets to achieve the fund's objectives. The objective is to make you money as an investor in the fund. And some people will say, well, why would a fund manager do that? Because that's how they make money as well. These are for-profit funds. The way you as an investor benefit is you're going to receive earnings on the overall performance of the fund. Sometimes these are paid out on a quarterly basis. Sometimes they're paid out on a monthly basis. I have seen funds that are also sometimes paid out on an annual basis. So again, these are important questions that you should be asking your fund operator before making an investment so that you clearly understand and have a general, very transparent idea of what your expectations should be. But that's essentially how you're making money. You're making money on the overall performance of a fund. Direct deals. So funding direct deals in the form of what they would call real estate notes basically involves investing in a debt instrument. So when you are buying a direct deal, you are essentially becoming the bank. You are buying a lien that should be secured against a piece of property. Now, that can be a residential piece of property. It could be a commercial piece of property. It could be a piece of land. Regardless, you should understand what the asset is that is backing your investment. But you are one investor. and you are buying one direct deal versus going into a pool with a bunch of other investors. You're essentially becoming the bank, is what I tell people. So direct deals, or a lot of people refer to them as notes. I'm sure many of you people that are on the webinar today have heard of notes. But essentially, your real estate note is a debt instrument, like I mentioned, and it's a representation of a promise to repay a loan secured by a piece of real estate. So a perfect example of it. You've got a real estate investor that is buying a property. They're going to do what's called a value add, and simply all that means is they're going to rehab the property, and they're going to exit this loan by selling the property or refinancing it. When you lend them money, there is a lien that is filed against the property. It's much like your mortgage. When you buy your primary residence and you use Wells Fargo to finance your loan, Wells Fargo has a lien against your property, and if you don't make your payments, their recourse is essentially to foreclose on the property. So this promise to repay is going to outline the terms of the loan. So it's going to include things like, what's the principal amount of the loan? What's the interest rate that's being charged? How is the loan being paid back? Is it being paid back on a monthly basis? Is it a 12-month loan? Is it a 15-year loan? Essentially, these are all the details of the repayment schedule on the loan. And then it's also going to outline the underlying real estate asset. So what's the parcel number? What's the legal description? All of these things are on this lien. And so it's very clearly defined. This is what the plan is. This is what the asset is that's securing this note. And this is how the repayment schedule is going to occur. Real estate notes are secured by the property itself. If the borrower defaults on the loan, the lender or the note holder that owns the direct deal has a legal claim to the property through foreclosure. So direct deals, unlike investing in a fund where you pool your money with other investors, funding direct deals means you are directly involved in the individual transaction. In the context of real estate notes, this might involve investing in specific loans or notes tied to particular properties. So diversification, I think this is something that is a great topic to talk about when you're talking about funds versus direct deals. So when you're investing in a fund, and for example, Central Lending's fund is a debt fund. So you may be buying one direct deal and you have $100,000 and you're buying a note for $100,000 and you have one deal. You could hypothetically put that money in a fund like ours, which is a debt fund, and we have 500 loans in that fund. And so there is better diversification across a range of assets. And essentially this is spreading your risk, right? If you have a direct deal and your one borrower stops making their payments, you're going to start to foreclose. And if you're a lender that's looking for cash flow, it's going to be affected, right? Versus putting your money in a fund where your $100,000 or whatever that amount is that you're investing is spread out over multiple assets. You're not going to see the effects of one borrower missing a payment as much as you are going to see a direct deal. So in my opinion, there is better opportunity for diversification when you're putting your money in a fund versus buying a direct deal. But there's also a lot of other things we're going to talk about today to take into consideration. But that's just something to think about, because I get some lenders that are like, hey, I'm in Texas and I only want to do deals in Texas. In my opinion, they're not looking for a lot of diversification because they're very specific to that market, versus the guy that calls me up and says, hey, I want to invest, but I want my risk spread out over multiple assets. In my opinion, they're probably going to be looking for some type of an investment opportunity like a fund. So hopefully that makes sense for you guys. I'm getting a little too happy with the clicking. The other thing to take into consideration is professional management. Funds are managed by experienced professionals who make investment decisions based on thorough research and analysis. And the other thing to think about with funds is the staff that's behind these types of assets, and a perfect example is Central Lending. When we get a borrower that comes to us that's looking to borrow money, we have a processing team that starts a process of due diligence. They're doing everything from from ordering an appraisal. They start to do their due diligence on the borrower. They're collecting things like credit reports, bank statements to make sure that they have the financial backing to service the loan, and also exit the loan. Exit strategies is something we look very closely at. We want to make sure our borrowers can realistically exit our loans. Once the processing team is done with their due diligence, then it goes to an underwriting team. Our underwriting team makes sure that the I's are dotted and the T's are crossed. Not until then are we going to close that loan. Then once the loan is closed, we have a servicing team that makes sure that the borrowers are making their payments. Once we have this set up in servicing, if this is a rehab loan, we also have a rehab construction draw department that manages the project, releases draws to the borrowers, orders inspections, makes sure that they're getting their permits, making sure that their contractors are signing lien waivers, and they essentially are managing that construction draw process to make sure that that project gets done. So there is a massive team behind us that is making sure that all these checks and balances are done. When you're looking at buying direct deals, sometimes if you're out there trying to fund your own deals, this is going to require you as an investor to conduct your own due diligence. Sometimes this is very time consuming, and many times it requires a higher level of expertise. Now, I will tell you, there are options to buy direct deals where you can buy direct deals that are already pre-funded and the due diligence has already been done. So it really is just going to require you to go in, make sure that I's were dotted and T's were crossed. So there are options for that, but it's important to understand that if you're going to buy a direct deal or a note like we were talking about, there is going to be a level of due diligence that you should be doing on your own. Even if it is a pre-funded deal, you want to make sure that things were done properly and correctly, and that you have all the information about that direct deal. So again, professional management funds, you have a little bit more benefit because you have a team behind you that is actually doing all of those things, versus finding your own direct deals is going to be a bit more time consuming and require a little bit more expertise on your end. The other thing to think about is liquidity, and this is something, and I'm going to talk to you guys about this at the end of the webinar, but there's some questions to be asking yourself before you even start diving into this. And liquidity is one of the things that I don't think people think about as much as they should. When you are investing in a fund, generally you're going to have a little bit higher opportunity to liquidate your asset if you want to. I've seen funds that have what they call tie-up periods anywhere from 12 months up to 5 years. So if you are going to possibly need a liquidity event, let's say you've got kids in high school and in 3 or 4 years, you're going to need access to your capital to pay for their college. Some of you guys might have these CISA accounts. Some of you might be investing your own personal funds, but you're wanting to get that money working for you, which is a great opportunity through a fund or direct deals. But you may need the ability to liquidate those assets and get access to that cash quicker than you might with other dollars. Funds are something to think about. For example, with our fund, we have a 12-month tie-up period. After that first year, if you want to exit the fund and liquidate your asset, your funds are returned to you within 30 days. So that's what I would consider a short tie-up period and a better opportunity for quicker liquidity. Direct deals may involve longer holding periods, and you may be limited to liquidating your assets. Now, you can look for direct deals or notes that have very short loan terms, like, for example, ours are 12 months. The thing to think about is they don't magically pay off at 12 months. Sometimes a borrower might come back to you as a note holder and say, hey, I know my loan was 12 months in terms. I got to the end of my loan term and I can't refinance. I actually just had a call with a borrower today. They may request an extension, so just understand, unless you're willing to go try to sell that note, which is also going to require you to try to liquidate that asset, your money may be tied up for longer than 12 months. There's no guarantee that you can actually be paid off right at the 12 months magically. This borrower I'm talking about, bought some properties. It was his intention to refinance them. He has not been able to refinance them. He is now 12 months past his maturity date. Now his lenders allowed him to what they call extend, but now they don't want to extend him any longer. So the conversation I had to have with this guy was like, hey, get these properties on the market and sell them, get your lenders paid off. So just understand what your liquidity needs are before starting to look at placing your money in funds versus direct deals. A lot of direct deals pay off at the loan maturity date, but it's no guarantee. So it's just something to take into consideration when you're looking at investing and deploying your capital in these types of assets.
Hey, Heather, I got a question. So when it comes to the context of like, that certainly is illustrative of, maybe what's happening in the market. What are some steps that funds specifically take to help to mitigate that? Because that's one of the biggest things a lot of clients look towards is saying, okay, well, investing in a deal directly, I hold the keys to the kingdom and I'm, putting this all together, but it also takes a lot of expertise. And one of the benefits to going through someone, a company that does this professionally is that, you have another set of eyes, you have a whole team working on it. But what are some of the things, at least, when market conditions change, that is happening? Is it stricter underwriting requirements? Is it higher interest? Is it just less money being lent out? What are some things that are being done, at least to help mitigate that? And what are some things in place that, at least you operationally take control of that might be benefit to clients investing in a fund versus a deal directly?
Yeah, that's actually a really good question. That's interesting that you bring that up too, because I was just at an event in San Diego last weekend with a bunch of investors that asked me the same exact thing. I think it's a lot of things. I think, and I'll speak specifically to a fund because I think that applies also to people doing their own direct deals. They should be looking at these things as well. I think it depends on the fund, and when I say funds, that is a very general term. There are funds like what we have, which is essentially a debt fund. We essentially go out and lend money to real estate investors, and specifically short-term debt, versus syndications. Those are more single asset funds where you're investing in a fund with an operator that goes and finds an apartment complex, right? And their exit strategy out of that fund is 5 years down the road, they're going to refinance it or they're going to sell it, and everybody shares in the profit, right? And I'll speak specifically about our fund as far as like risk mitigation, as far as what we look at right now, because we are dealing with short-term debt. We keep a close pulse on our borrowers, and we look at it as an overall portfolio. Things that we look at are things like, have they been able to exit their loans on time? How many of them are asking for extensions? Because that's a big indicator that something's going on in the market, right? Maybe they're not being able to sell them like they thought they would. Maybe they're not being able to refinance them because the values aren't there. Value is another thing that we look at very closely. Okay, what was the value of the property when we did the loan? And when they sold that loan or exited us, did they sell it? What was the value at that time? Because that's also an indicator that there's a shift in the market, right? And when you track those things and you are mindful of what's going on with your borrowers, that can allow operators like us to make changes in things like you mentioned, loan to value. If we are seeing a decline in values, we're going to start to roll our LTVs back. You don't want to be super aggressive in a declining market. What we've seen most recently with interest rates rising, people aren't selling their properties. People aren't upgrading, because they have a mortgage on their house at 3%. They're not going to go buy another house that's more expensive and pay 7%. So there are not as many houses being sold, which is also affecting, some of our borrowers with exiting our loans by selling the properties. We look at things like what kind of asset is it? We like the affordable housing market space because if a borrower gets in a bind and can't sell it, which would be an indicator of extensions, at least if they're in that affordable housing market space, most of the time they can rent them and cash flow them to keep servicing the debt. So to your question, it's a lot of things, and whether you're a big fund like ours and you have, 500 assets in it, or you're a direct lender and you've got 20, 30, direct deals, these are things that you should be looking at. How often are your borrowers paying off on time? Are they asking for a lot of extensions? When they are paying off, are they selling them and making a profit? And so that way, when you're looking at doing new deals, whether you're a direct lender or us, you can adjust your loan to values, your qualifications. Another thing with borrowers is like, hey, have you done this before? Do you have verifiable experience? And if you're starting to see these challenges in the market and people not exiting their loans, I would probably start to dial back on lending money to first-time real estate investors. So it's a lot of things. And like I said, whether you're a fund like ours with a big portfolio or you're a small one-off lender, you should be looking at all those types of things, because I think those are all very good indicators of, things that you may need to make adjustments on. So hopefully that helps answer that.
No, great answer. Thank you.
Okay, so this is another thing that comes up a lot, accessibility. I get people that call me, well, why would I put money in your fund and you guys make money off these deals when I can just I can do these deals myself? There is a factor of accessibility. Funds do provide access to a wide range of different markets, industries, and asset classes that as a one-off lender might be difficult for you to get direct access to. And an example of this is, our fund lends all over the United States. There's probably 6 to 7 states we don't lend in, but the way that we have access to all these deals is we work closely with brokers. We aren't physically in all these markets, but we've got brokers in all these different markets we're doing deals to that are bringing them to us, right? We may or may not fund the deal, but at least we've got this wide range of access to all these different deals. That is very difficult to do as an individual. You are sometimes limited, and what I've seen with direct lenders, unless you are buying direct deals from like a company like ours, your guy that's putting a ad on Craigslist or going to REI meetings, presenting himself as a direct or herself as a direct lender, a lot of times you are limited to specific locations. And for some direct lenders, that's okay. Some of my people I work with are like, hey, I only want to do deals in my specific, area or market that I'm located in. And that's fine. But it does limit you sometimes to the accessibility and the deal flow that maybe you're looking for. And so I do think that to that point, funds do provide a little bit more accessibility to a lot of different deals and a lot of different markets, which also, goes back to what we talked about with diversification. And direct deals are going to limit you typically to specific areas. And like I said, as an investor, sometimes that's what you're looking for, and that's perfectly okay. But it's just something to kind of point out that is one of the differences between going into a fund versus finding your own direct deals. Lower transaction costs. Funds benefit from economies of scale, which can result in lower transaction costs to the large size of a fund and portfolios. Direct deals may involve higher transaction costs. And I put this up there because I specifically experienced this recently with my self-directed account. One of the things to think about with direct deals, you will get paid off. I mean, that's the whole goal, especially if you're looking at short-term loans, right? And there are costs involved with using these custodial accounts, which is okay, right? I mean, there's a cost to doing business. One of the things that my husband and I have talked about is, for us, I don't know that, because we're not at an age where we're taking the required distributions, we really just want to set our custodial accounts somewhere and forget them. Funds can give you a little bit lower transaction costs because, for example, with central lending funds, you can actually set your earnings to be reinvested. So at the end of the year, we would let Advanta know, hey, here's their fair market valuation form. The challenge is sometimes with direct deals and any investment that pays regularly, one is you're going to have those earnings go back into your custodial account. And the challenge with that is you have to wait till you have enough built up in there to reinvest those dollars, right? Because most funds have a minimum investment. Obviously, a direct deal has a minimum investment. If it's a $30,000 note, you got to have $30,000 to invest in it. So funds can solve for that, where you can set them up to just reinvest your earnings and keep that money working for you all the time. And then also solve for the problem that if you get paid off with a direct deal, then you have those funds sitting there in your custodial account. You got to find another home for it. So just things to think about. I think it comes more into play when you have those small dollar accounts, which is what we experienced. So for us, we have one IRA that is smaller in dollars. It makes more sense for us to actually invest it in a fund where we can just keep it rolling all the time, obviously, and then update our custodian, at the end of the year as far as what our fair market valuation is. So just keep that in mind when you're looking at investing, especially with custodial accounts. What are you trying to accomplish? Are you at an age where you're taking required distributions, or are you just trying to set it and forget it? Think about, the fees and the costs involved with that too. The other thing with direct deals, you may have some costs involved with title insurance, having an attorney close a direct deal. So there are direct deals out there. We actually offer them where you're not going to have to pay that because they've already been closed. But if you're trying to do this on your own out there, there's going to probably be some cost involved for you. So just things to take into consideration and think about when you're out there vetting deals. So funds offer the ability to customize your investment. And what I mean by this is, depending upon the fund and the operator, you may be able to choose the duration of your investment. You should always know, you should be doing your due diligence, but you should always know what is the amount of time that I'm going to be tying my capital up for, right? And you can choose accordingly. We have an example of that is we have the ability for our investors to choose 4 months, 12 months, or 24 months to tie up their capital. Where with a note, you're going to know what the loan term is, right? But it's also not totally a guarantee that they pay off. Most of the time they do, and in a perfect world, borrowers pay off before their loan matures, but there may be that risk that, like I was talking about, depending upon what your liquidity needs are, that it may not pay right off when you're expecting it to. There are funds out there that offer fixed rate of return options. We do offer that. Some lenders really like that. Versus the lender that's like, hey, I want to invest in that apartment complex. I know that potentially I might have 20% returns on my investment, and this is long-term capital. I'm fine waiting for that. Versus the guy that's like, hey, I don't want to worry about this and whether this operator is going to exit in 5 years. I'd rather know that I'm getting a guaranteed 10% or whatever that rate is. So there are funds out there that you can actually invest in that are going to provide you with what we would call a fixed rate of return. Funds offer the ability to invest through custodial accounts. Most funds out there do offer that opportunity. Now, one thing to keep in mind when you're investing your custodial accounts is the UBIT concerns. And this comes into play when a fund leverages their assets, meaning a fund can actually go borrow money against their assets. And it's really common out there. It's a way to really juice the yields to investors, but just understand that can trigger UBIT. Alex can talk to you more about that offline. I'm not going to go down a rabbit hole with that, but it's something to ask because you don't want to be surprised at the end of the year when you have experienced that you may have to pay UBIT tax. So just keep that in mind. And then also, again, funds offer the ability to reinvest your earnings. And this, again, just eliminates your undeployed capital. I think that's a really powerful tool. Our fund actually reinvests earnings on a monthly basis, which essentially is compounding your earnings. So you can run some compounding calculators out 5 years. It is a huge difference in your returns. So that's something to consider as well. Some of the things to consider when talking or evaluating direct deals, they do offer more control over some of your investment decisions. So this allows you as an investor to be more active in your portfolio. And some investors are really looking for that. I mean, it's kind of a 50-50 split. I mean, honestly, I have probably half of my clientele that's like, I only want to do direct deals. I don't want to be in a fund with a bunch of other people. I want to actively decide what I'm investing in. I know at the end of the day, the risk in these types of investments, but I like direct deals because I control it. Versus my fund investors that are like, I don't want to deal with it. I'm retired. I am traveling. I don't want to deal with a borrower not making a payment and having to make decisions on that. I would rather align myself with a good operator that has a track record. that, meets the needs of my dollars, and I don't want to deal with it. So it's just things to think about. And there's nothing that says that one is better than the other. It really just depends on your appetite as an investor. And again, some of the other things I'll talk about at the end of the webinar to think about and consider when you're, trying to decide what would be the best fit for your dollars. Customization. Direct deals allow you for a more tailored investment strategy based on your preferences and goals. Some of the things that I think allow this is, like, if you are geographically really inclined to only invest in a certain location, you can be very specific about that. If you are very specific about a type of property, maybe you only like commercial, or maybe you only want residential, or you only want a duplex, you can be really specific about that. Maybe you only want to lend to a certain type of borrower and for a clearly defined amount of time. Direct deals allow you to be real specific with that. Now, if you have too many things that you're looking for, it makes it hard to find that specific kind of deal. But again, you can narrow it down and say, hey, I only want to deal with Texas properties. I only want to deal with a borrower that's done this before and has a proven track record. And I only want to deal with a borrower that puts 10% down. Those are the kind of things I'm talking about as far as being really specific and tailored in your strategy. And also rate. I have lenders that do only direct deals, and they're like, don't send me anything under 10%, or don't send me, anything under 9%. You can really customize it that way. Funds, on the other side of it, offer more of a pre-packaged investment strategy. This does limit you the ability to customize, but you still can do your due diligence on the fund and understand what kind of assets, what kind of underwriting, you can, to some extent, customize it. It's just going to be a broader customization, right? For example, our fund, we invest and lend only on residential real estate up to 4 units. So if you were somebody that came to me and said, hey, Heather, I want to go in a fund, but I only want commercial, I don't like residential, our fund is not going to be for you. So you can still customize it. It's not going to be quite as tailored as direct deals. But for some people, they don't have the time. They're professionals. They don't want to do all the due diligence with direct deals versus, a fund situation. So again, it really kind of goes back to your appetite. And the more that you can clearly define this before you start calling operators like us and looking at direct deals, the more successful you're going to be. Otherwise, you're going to have analysis paralysis. Risk tolerance. Direct deals, investors have a direct influence on risk exposure, allowing for more precise risk management. Funds, exposure to the overall risk profile of the fund, which may not align perfectly with your individual preference. So, if you are looking at funds, understand what the risk profile is. What do you guys invest in? What are your limitations? Direct deals, obviously, you can be a little more hands-on with that and make those determinations. But you really, as far as investing in funds, need to do your due diligence on the operator and their assets. So a couple things that I just wanted to point out with direct deals and real estate notes, some highlights on them. They're going to give you consistent cash flow. Real estate notes typically have monthly interest-only payments in the world I live in. And so this is something for you folks. If you are trying to create cash flow for yourself, real estate notes are a great option for that. I say that with caution, because the last thing I want to do is encourage you to do that if you're trying to live off the cash flow and then you have a borrower not make their payment. You're obviously not going to have cash flow, but just keep in mind, in a perfect world, if a borrower makes all their payments, it does create cash flow for you. It's an asset-backed security. So again, this is a tangible asset. You have a lien against the property. It does allow you diversification with real estate. So instead of dealing with tenants and toilets and contractors, you can just be the lender and you're still investing in a real estate-backed asset, but you're not dealing with all the headaches that come along with being the actual property owner. Real estate notes come in various forms. You can buy performing notes. This is where the borrower is actually making their payments. Non-performing notes is, obviously where the borrower is not performing on their loan. So sometimes they're not making payments at all. Sometimes they're just behind in payments. In a non-performing note situation, this is an opportunity to typically buy a note at a discount. So what I mean by that is the principal balance of a note could be $100,000. You might be able to go in and buy it for $70,000. So that is what I'm talking about as far as a discount goes. Most people's strategies with non-performing notes is they'll get them reperforming and then they'll sell the note, and then you sell it for $100,000. Well, there you just made $30,000 on your 70 grand. So I won't go down a rabbit hole with non-performing notes, and there's a lot of strategies to them, but just understand that's typically the investment strategy behind buying a non-performing note. So, what it boils down to is you can choose notes based on your risk tolerance and your goals. You can, try to look for notes that are at a certain rate of return. But just understand, all the risks in doing all those different strategies.
Hey, Heather, we got two questions that chimed in here.
Sure.
One said, could you speak into how you can, quote, juice returns with lending against your fund assets? And then the follow-up to that was, where do you find discounted notes, and is there a marketplace for that?
Sure. So juicing your yields on a fund is, let's just use a syndication, for example. So a syndication goes out, buys an apartment complex. They're going to buy it for, $5 million. They're going to raise a bunch of capital, and they're going to buy that asset. They're going to agree to pay their investors 8%. Let's say it's an 8% preferred rate, and then you share in the upside when they sell that property, right? That apartment complex is going to create cash flow. That operator might go out and obtain bank financing. Now, leveraging a fund like that is not as lucrative right now with the interest rates where they were, or they are. But if you had looked at this 2 years ago and capital available was at 4%, right? So they could go borrow money at 4%. They could pay back all their investors. They all get their capital back. Now the investors are getting paid on the cash flow of the rentals coming in, and they're going to share in the profit when they sell that property. So now those investors don't have any of their money into the deal. They're getting paid cash flow. The fund now has leveraged the fund and gotten cheaper capital than the 8%. So now they're not paying the 8%. You're just sharing in the rents coming in. That's what I'm talking about, juicing the yields, right? They've found cheaper capital. The investors still profit in the deal because they're still members of it, but now they've gotten their capital back. That's one example. Another example is a debt fund like ours, right? We might lend money out at 12%, but we leverage the fund, and you don't ever leverage it for the full amount of the assets. If you've got $5 million in there, you're not going and borrowing $5 million. You're probably going to leverage $1 million line of credit, right? You might be able to obtain financing from a traditional bank at 6%, but we're lending at 12, so we're still getting the upside of 6, but we have cheaper capital. There's a lot more that goes into it, but just from a high level, that's what I'm talking about. So it gives the fund the ability to lend more money because they have this line of credit. And, the whole strategy is that you're lending it out at a higher rate than you're paying for the capital. Hopefully that makes sense and answered that question. And then what was the second question again, Alex?
Sure. Where can you find discounted notes, and is there a marketplace for that?
Oh, yeah. Okay, so discounted notes, they're everywhere, especially right now. There's a great resource called PaperStack. It's an online platform, and you can find performing notes on there. We actually have some of our notes on there, as well as discounted notes. And you can negotiate with the sellers. PaperStack is a great resource. Some people, buy discounted notes from big banks. Now, these are typically going to be owner-occupied notes, which come with some other challenges, but you can buy discounted notes. Go to your community bank. Sometimes they have non-performing notes. Now, they're typically going to sell you a pool of them, right? They're not going to just sell you $100,000 note. They're probably going to say, hey, we've got what they call a loan tape of $1 million in non-performing assets. Do you want to buy it? And you essentially make an offer on the total loan tape. Paper stack would probably be your best resource to just buy one-off notes. Like if you've got, 150 grand in your self-directed account and you want to go try to buy a discounted note. You can also search Eddie Speed. He has a platform and company called Note School. He is well connected with discounted notes. So that's just a couple of resources.
All right, great. There's two other questions, but we'll let just know that if you ask another question, we'll get to those in a little bit. We just want to kind of keep the presentation moving. But the other two questions that were in there, we'll get to those in a minute. So just hang tight. Okay. And Heather, if you just want to continue moving along.
Yeah, I'm just about to the end. So like I said, basically the conclusion is whether you're choosing between a fund or direct deals, it really boils down to what your goals are, what your risk tolerance is, what your appetite for these deals are. And a lot of investors do both. One of the things that I think sometimes dictates whether you put money in a fund versus direct deals is the kind of dollars that you're investing in. Like I talked about, a fund might be a better option for a custodial account because you can keep those dollars working. But there's nothing that says that you can't do both, and I have most of my investors, honestly, I can't tell you any investors that just do one. I mean, a lot of them do both. And so just know that it really just kind of, you really need to sit down, whether you're an individual or a husband and wife, you got to kind of decide what you're trying to accomplish and what your risk tolerance is, and then kind of back into the deals from there. And I think you guys will be more successful. Essentially, we have two investment options. You can contribute into a fund, and you can also buy direct deals with us. Ours are all short-term notes, residential properties. Really kind of where the journey with central lending starts is you have a conversation with me, and you give me an idea what you're trying to accomplish. And then I think it's really important for investors to do their own due diligence, whether it's with central lending or any other fund or any other direct deals. I can't tell you how many horror stories I hear on a daily. Well, I didn't really look into this guy. Now he's not paying me. And and sometimes it's just that they didn't understand and have realistic expectations of how they were going to get paid and when they were going to get their money back. And sometimes it's fraud. So, you guys have self-directed accounts because they're self-directed. So there is some level of responsibility and due diligence you need to do on yourself or on your investments that you're looking at. And I will tell you, if you are talking with an operator and they don't want to answer questions and they're not answering the right questions, probably an indicator it's not the right operator for you. If you want to invest in real estate without the headaches of tenants and toilets, funds and direct deals are a great option for that. I wanted to pull this next slide up. This is what I was talking about. Before you even, if you're new to this and you haven't talked to a company like ours or looked at your own direct deals, I really encourage you to sit down and literally write this out. How much do you have to invest? I get people all the time. I want to look at this direct deal. Well, it's $100,000. Well, I got $20,000 in my IRA. Well, there's no reason to even look at it because you don't have enough to invest in it. So decide how much you have to invest, and it can come from multiple accounts. I have husband and wives that buy direct deals, and they each have 50% of the deal in their IRAs, and we can split it up and make sure that everything's reported correctly. So it doesn't have to just come from one account. Are these monies, understand where the money's coming from? Is it your personal funds? Is it qualified dollars like your, custodial accounts? What are you trying to accomplish? Growth versus cash flow. If you're trying to accomplish cash flow and you're investing in a self-storage unit that the upside is all paid in 5 years, that's probably not the right investment to be in. You want to look for a fund that pays out on a more regular basis, on a monthly basis, or maybe a quarterly basis, where maybe a self-storage deal is a better fit for a growth investment model. Remember, I talked about liquidity. Have that conversation with yourself or your partner. Like, how long do you want your capital tied up? You go invest in a fund that pays out in 5 years and you need access to your capital in 12 months. That's not probably the best fit. And then also one of the other big questions is, are you specific to a certain area that you want to invest in? And I think these questions apply to whether you're doing a direct deal or a fund. These all are pertinent to both investment vehicles. I'm going to leave this up while we answer questions. That is my direct number, my email. That QR code, you can actually just go to that and put your information in, and I'll reach out and we'll just schedule an appointment if you want to talk more or have additional questions. But we've got time for questions here too. But just know that that QR code is just to get me your information, and then I can follow up with you and we can schedule a time when, you know, we both have more time and do some one-on-one if you want to dive deeper into any of this stuff.
All right, great. Thank you so much, Heather. So yeah, we got some questions to get through. Make sure if you do have any, you start typing those in. We'll get through these here now. So the question we had was, when investing in funds, how is the collateral assigned to the investors? Will the fund absorb the loss if one investment went bad, thus impact the overall yield?
Yep. So the fund is the owner of the assets. When you invest in our particular fund, you are investing in an LLC. So you are what's called an equity member in the fund. And so those assets are assigned to the fund, and you are an equity member in the fund. So if one asset goes bad, you know, we as a fund operator manager, we are just managing the fund on your behalf. I mean, a lot of us have our own money in it, but we just manage it. And so we make those decisions for you, but we also report on it on a quarterly basis. You would always be updated of any of that type of information. But ultimately, the fund owns all those assets, and you are an equity member. If you had $500,000 in our fund and our fund was $1 million, you would be a 50% equity member.
All right, let's see. Question is, where can we find more about increasing yields? This is a great topic. I think it was in the context of the juicing the yields question. So is there any like other resources about there about how that kind of stuff works, or some information you might have additionally to that?
I don't have anything like in writing about that, but like, here's a perfect example of how you juice this, right? I have had clients in the past, and I don't think it's pertinent right now given the interest environment we're in, but when rates were at 2 and 3%, right? I had investors that would go get a HELOC loan. So they would get a home equity line of credit on their house. They'd borrow money at 3%. They were buying direct deals from me at 12%, right? So their upside was a 9% return on money that they borrowed. And that's what I was talking about, juicing their yields, right? A fund functions very similar to that, but it has to make sense. You know, right now in the rate environment we're in, unless you were a fund that obtained lines of credit, you know, 2 years ago, it probably doesn't make sense right now. And I'm happy to talk offline. I guess what I would say is, if you want to talk further about that, go to this QR code, put your info in, and there's a box where you can actually put a comment or notes. Just put that you want to talk about that. I don't have anything in writing. I'll look around at some resources too, and see if there's some literature out there. I know a few books that you might read that might be helpful too as well. But just reach out and I can get you some resources on that.
Great. There was another question. I think we covered this pretty well, but again, any additional thoughts? This is a very important question. What are your advice on evaluating funds? There are many real estate funds out there. Anything past what we kind of went on evaluating, at least from my perspective, my anecdotal thing on any, looking at investments is ask the hard questions. We at Advanta, specifically for what we do, we can't do any due diligence on an investment that someone might want to do with their IRA. So it all boils down to the diligence and the comfortability and the suitability of the investment for you as the client. So any of those hard questions, what happens if the principal, passes away, and what happens, in a down market, what happens if X, Y, and Z happens, ask these tough questions. You are giving your money over to someone to be a steward of your capital, and you need to be comfortable with it. But that's kind of what I tell people is, don't be afraid to ask the hard questions, because you'd much rather ask the hard questions up front than in a courtroom. It's much easier
100%
question answered up front. And I'll turn it over to Heather for her thoughts on that as well.
No, I couldn't agree with you more. I just, there are some things to ask and look for, a couple of them that are really big red flags, in my opinion. I would ask if a fund has their fund fully audited. And what I mean by that is a fund that has a third party massive auditing firm, which is outside of their company, coming in on a yearly basis, looking at their books. That is really important. and here's the thing, you are not required to have your fund audited, but as an operator, that is best business practices to have your fund audited. It protects you as the operator and it protects your investors. So first, ask them if they audit their fund. The other thing is third-party fund management. So we use a company called Dreves. Dreves is a company out of Portland, Oregon, and they do third-party fund management on financials. So our financials are done every month by Dreves. It doesn't mean that you can't do them internally. That's not a huge red flag for me, but I think that having a third-party fund manager is an added layer of security. I mean, even if a fund is auditing their fund every year, that's 12 months away. I mean, a lot can happen in 12 months. You know, when you have an operator that is using a third-party fund management company on a monthly basis, there's a lot less room for error and misappropriation of funds when there's another set of eyes looking at it. So those are two of the things that I would ask. I would also ask a fund operator, and to Alex's point, ask the hard questions. Hey, what's going to happen if everything goes sideways? I mean, you know, in a perfect world, borrowers make their payments, properties sell. Well, what happens if that doesn't happen? You know, how, and I think somebody already asked this, how are the assets in the fund secured? You know, so I think you need to ask those hard questions. I think you also need to ask a lot of questions about how often do they report? Hey, how often am I going to hear from you? If you think you're going to hear from them every month and they don't report more than every 6 months, you're going to be really disappointed as an investor. So I think it also boils down to your expectations. Like if you want constant communication, but that fund doesn't offer it, well, then that's not the right fund to be in, you know, as well. But again, to Alex's point, you need to ask the hard questions. Ask them if they're auditing their fund. Ask them how they do their fund management. It doesn't mean you have to have a third party, but I do think it's an added layer of security. And dig into it. And if they're not willing to ask those questions and be open and transparent with you, that's probably an indicator that that's not the right operator for you.
Yeah, absolutely. I think those are all very pertinent points. And then the last question, which Heather, I prefer if you maybe connected with this person offline, is asked, what return can one expect from your fund? You know, we do need to strictly stay very high level when it comes to actually specific returns, especially if we have someone on that is an investment provider. We prefer just that you connect with them directly, just kind of with regard to our compliance as, you know, and non-investment. Yep. We just like to have that kind of stuff connected offline. So to the person that asked that question, certainly Heather's information is right up there, and as she explained how to schedule a consultation. So just follow up with them separately, and I'm sure she'd be more than happy to go through, you know, what people can expect when investing with them. Now, that is the last of our questions that I had that have been typed in by the participants. Thank you so much for your participation, and this is kind of hitting right up on the top of the hour, so I think that's kind of a perfect place to leave it off with. Heather, again, really appreciate you being on with us today. The most valuable resource that we all have is not money but time, considering we can't ever make any more of it. So I appreciate you taking time out of your day to come and speak to our audience regarding this great topic, and I'll leave you with any parting thoughts before we actually end this thing up.
Well, thank you, Alex, and to the Advanta team for having me. You know, I have a passion for educating people, and I'm always open to have conversations. I'm more than happy to direct anybody to other resources as well. So I encourage you to reach out, whether that's through, you know, email, phone, or, you know, you can always go to the QR code if that's easiest for you, but more than happy to talk offline. Obviously, you can get anybody that's interested. You know, the other thing you need to be asking for is their prospectus or their PPM in a fund. So we have that and can talk about, you know, historical returns and things like that. But thanks again. I really appreciate it. It's a great use of my time, and, you know, more than happy to connect with anybody that wants to.
Fantastic. Well, with that being said, thank you so much for joining with us today, Heather, and for everyone that attended the webinar as a guest. We do appreciate your time here as well. Have a great day.